All right, so let's continue and go over this example here again.
Computing profitability and valuation ratios. Here we have some real data from 2012 for Walmart and Target, and we want to compute a bunch of metrics like their operating margin, net profit margin, their price to earnings ratio, PE ratio, and the ratio of enterprise value to operating income and enterprise value to sales. We have all the information we need. We just need to take the formulas for each metric and combine the right data. So if we go here to the table and we say, okay, let's start with operating margin, operating income over sales. So for Walmart, operating income is 28, sales is 469, and similarly for Target, we've got 5 and 73. So you see Walmart's actually much bigger than Target, and they have slightly different value propositions in that Target tries to aim for a somewhat higher end product than Walmart. But let's go through and compute their operating margin. So for Walmart, it's going to be 28 over 469. And for Target, it's going to be 5 over 73. And if you go through, you get 0.06, which is 6%. And for Target, you get 0.068. So Target has a slightly higher operating margin, which might be expected if it's selling slightly higher end goods, that it has a higher profit margin. Let's check the net profit margin, however. So the net profit margin says look at their net income, their earnings. So how much did they actually earn per dollar of sales? And so for Walmart, net income is 17, Target is 3. Sales are still 469 and 73, so we've got 17 over 469, and we've got 3 over 73. And when we actually calculate that out, we get 0.036 or 3.6% for Walmart and 0.041 or 4.1% for Target. Again, Target has a slightly higher profit margin, a little bit more profitable. Let's look at the PE ratio. So this is what does the stock market think the stock is worth per dollar of earnings. Okay. So in order to do that, you need to take the market capitalization over the total earnings, which is net income. Remember, earnings and net income are the same here. So we're going to have 222 for Walmart over net income of 17, and that's going to give us 13.1. And for Target, we've got a market capitalization of 38, and we've got net income of 3. And if you divide that one out, you get 12.7. So actually fairly similar PE ratios, both pretty close to 13. So they have somewhat similar growth expectations in the stock market, that for every dollar in earnings that Walmart or Target is making today, you're paying about $13 to own the stock. Now let's look at the enterprise value ratios. Okay, so enterprise value, in this case, for Walmart, for example, is going to be the market capitalization plus the debt minus the cash. So we've got 222 plus the debt of 54 minus the cash of 8. That's the enterprise value. And then we've got the operating income, which is 28. So remember, the idea of the enterprise value is to give you a sense of the value of the business net of the cash that it's holding. So 268 is what we have on top, and when we divide it out 28, we get about 9.6. Do the same thing for Target, and you have 38 plus 18 minus 1 over their operating income, which is 5, and you're going to get 55 over 5, which comes out to exactly 11. So a little bit higher enterprise value ratio there for target. And then finally we can do enterprise value to sales. So the enterprise value is the same here, 268. The sales is 469. So we get 0.57. And then similarly for target, we have the enterprise value of 55, sales of 73, and we get 0.75. So these provide a way of sort of comparing the two firms based on their profit margins, market expectations of growth, market valuation relative to dollar of operating income or dollar of revenue.
Okay, so I hope everybody found that interesting. All right, so we're getting toward the end of so we got now the operating returns. So this is return on equity, right? So basically this is net income over the book value of equity, net income with the income statement. This is the balance sheet, okay? And then we have the return on assets, okay? Which is net income plus interest expense over the book value of assets. Again, these come off of the income statement, and this is the balance sheet. All right, return on invested capital. EBIT times 1 minus the tax rate over the book value of equity plus the net debt. And there's a nice example here. Again, go through these examples and understand where the numbers come from, more important than the basic math. Okay, let's go through this.
Computing operating returns. In this problem, we're going to take a look at how well Global is using its assets by comparing its ROA, return on assets, in 2012 to its return on assets in 2013. The table has everything we need to know in order to actually compute its ROA, its return on assets. Remember that ROA is net income plus interest expense over total assets. So the idea is the net income is what goes to the equity holders, the interest expense is what goes to the debt holders, and the total assets is what you used to generate that money. So ROA for 2012 is going to be 1.9 plus 4.6 over the total assets of 128.9, and when you actually calculate that out, you get 5%. If you do the same thing for 2013, we've got net income of 2, we've got interest expense of 7.7, and we've got total assets of 170.1. So you can see they generated a total of 9.7 off of assets of 170.1. And when you actually calculate that out, you get 5.7%. So Global has increased its return on assets from 5% to 5.7% from 2012 to 2013, suggesting that it's getting more dollars out of each dollar of assets, and it's using its assets more effectively.
All right, so I hope everyone found that instructive. All right, so we're getting the DuPont identity, which basically takes a couple. All the DuPont identity does is take a couple ratios and combines them here. Okay, so that's all that basically is. And again, go through this example and find where these numbers are coming from. Okay, and they compare Walmart and Target here. Okay. All right, so here's a bunch of nice table with all the ratios in there. Okay, a nice, put them all together, all the ratios. Again, you should, have these in front of you for the exam. All right, so I believe that's it. And there's a nice thing here about Enron and the games they played. Okay, so you might find that interesting. And here's WorldCom, another case study of financial statements gone wrong. And here's a nice blurb on the Sarbanes-Oxley Act, which came as a result of Enron and WorldCom. Okay, so again, you should read that. This is a nice information. And here's a nice thing about the global financial crisis of 2008, about 13 years ago. Well, this is really informational and it's great. And here's the Dodd-Frank Act, which came on the heels of the Sarbanes-Oxley Act. So all these acts are pretty important, and you should, read about them. All right, so that's it. Here's the summary of everything you'll need here. The income statement. And this is a nice summary here with all the ratios. So that ends it for chapter 2. Okay.